Welcome to the deep dive video update. And I always want to explain this. My context of deep dive might be a little bit different if you're watching this video for the first time. Every week I do a number of different videos. I do a daily video, I do a weekly video, I do an intermarket analysis video. After doing all of those videos, I go back through and I look at the charts, specifically the daily charts, and I pick out those charts that sometimes I use in the daily videos and sometimes I don't, and I put them into this video. Also, there are additional videos that I only post in this particular video to give us some insight as to what's happening in the market. This is being prepared for Monday, December 9th. Before I get into the video, I want to tell you about the SPX investing program. It's up, it's going. If you want to learn more about it, there's a link that will take you to the website or to a video. Here is an email address where you can contact me if you have any questions, and it's free until the end of 2024. Also, the daily video is the real foundation of the analysis that I do. You can see around the outside, here's the deep dive video. This is just one weekly video that I do, but everything is meant to tie into the daily video. The first chart that we look at is a chart of the VIX, and this just gives us an idea over a long period of time. What is the general range of the VIX by placing a 50-period moving average here and then turning the VIX invisible? And we're down into a lower range now as the market's been going up. We were running into a little bit of problem and the VIX was going up heading into the election. But now that the election has passed, we're starting to turn back down and we're getting pretty low readings each day with the VIX as it's been coming down as the S&P has been going up. Also, another VIX study is we take a correlation of the VIX and the S&P 500 and we look for a real high reading on this chart. Well, right now we're going back up a little bit, but we're still seeing a real high reading, or excuse me, a low reading together here. So we're not really getting anything from this chart right now, meaning there's not a lot of fear in the market. Also, we look at the VIX and then look at a ratio of the VVIX, which is the volatility of the VIX. As a general rule, when this is going down, as it is now, that tends to be more positive for stocks. Then we look at the volatility of stocks, which is the VIX, and the volatility of bonds, which is measured by the MOVE index. And overall, we've been seeing volatility going down with this ratio, and that's been more positive for the market. And we look at another ratio between large caps and small caps, and we're seeing over the last few trading sessions this past week where the mega caps are really leading things higher. That's why the S&P is hitting all-time highs. But the rest of the S&P isn't really participating. Well, we can see that we started to go back up with this ratio when we look at large caps versus small caps. And if this continues to go up, that just means the large caps are outperforming. We've been spending a lot of time chopping sideways since, early part of summer. Then, just for informational purposes, going back to the previous all-time high that was set in early January of 2022, we're up 26.39% from that previous all-time high. Then we go back to the low that was set in October of 2022, and we're up 74.28% from that low. And then we set another low in October of 2023, and we're up 48.41% as of Friday's close from the October 2023 low. Then stockcharts.com has this thing called technical alerts. I go through them each day in the daily video, but what you see here are the alerts for the whole week. And typically, if they're more green or blue, depending on what color you see, that's more positive. And we started off more positive earlier in the week, specifically in the NASDAQ. Now, the NASDAQ and the NASDAQ 100 have been hitting all-time highs. And we're seeing more tech and the mega caps really doing well right now. And that's been helping the overall market because a lot of stocks that are in the NASDAQ and pretty much all the stocks for the most part in the NASDAQ 100 are also in the S&P 500. But the S&P 500 has 503 stocks that are produces more of a balance. So it tends to underperform when we're really moving up, but it tends to hold up a little bit better when we're going down. But with these alerts, you can kind of see just looking at the colors, are we tending to be more positive or negative? And we start at the bottom. This was Monday's session, and then we finish all the way at the top, which was Friday's session. Then another thing that I do is stockcharts.com has a thing called technical scores, which tries to remove all the emotion from technical analysis, which technical analysis, that's why it was created, to look at what's actually happening and remove as much emotion as possible. But you can have different folks that all look at the same chart and can interpret it in different ways. Well, this tries to go another step by just taking technical indicators and then putting them together and ranking an index on a score of 0 to 100. Now, you can also do this with a stock or a sector, but I use this with indexes. Now, the S&P 500, that's the one that I really focus on, but I also look at the Dow, I look at the NASDAQ 100, I look at the mid caps and the small caps, and then rank them here in this next section. We're actually coming in first place right now are the small caps, which is the IWM. This is the Russell 2000 small cap ETF, and it's looking the best this week. Now, when it gets really strong, we'll get a score up into the 90s, but right now it's coming in at 83.8. Then in second place, which had been lagging since last summer, about July, the QQQs, which is the NASDAQ 100, they're coming on and showing a little bit of an improvement here, and they come in second place at 83. Then in third place at 79.1 is the S&P 500. So it's doing well, but it's been underperforming the small caps and the mega caps right now. And then we look at the Dow coming in next at 77.2. And then the weaker area, which also has been improving but trailing off over the past week, are the mid caps coming in at 73.2. Then we look at some short-term charts. This is a short-term rainbow. The reason why it's short-term is we have shorter-term moving averages on here from 10 periods up to 50 periods. And then we plot this and we can see that all of the lines in the rainbow are going up and prices above all the lines. So this just shows that the short-term trend is positive. Then another intermediate term rainbow going from 50 periods up to 100 periods, also quite positive here. All the lines are going up and prices above all of the lines. So the intermediate term trend continues to be positive. Then we look at Bollinger Bands. Now, I did show this earlier on because we closed just a little bit above the upper Bollinger Band, and there's lots of different ways that you can use Bollinger Bands. This particular implementation is called the percent B indicator, and that just measures when we're above or below the upper Bollinger Band. And we're positive when you look at this down below because we're above the midpoint, but we're not getting an extreme reading right now. Then, how are we with the 50 period moving averages? And I plot both the simple and exponential moving average on here. We're well above the 20 period moving average. So I haven't been showing this in the videos because first we would have to drop through the 20 period to get down to the 50. The way the chart is set up right now, this is still looking quite positive, and this is more intermediate term as well. And then intermediate to somewhat long term is the 100 period moving averages, and the lines are going up and prices well above the moving averages, so we're looking positive there. And then another approach to using trend analysis is called an Ichimoku cloud. And when we're above the cloud like we are now, that's positive. Because if we fall back, a lot of times this cloud, some part of this cloud may end up providing support. Well, then there are additional studies that are placed on here. We have the blue line and the red line. When the blue is above the red, that's positive. Also, there's another green line back here, and that continues to go up as well. So we're not really getting anything from this chart that we're not getting from other charts. So this is looking positive, but I haven't been showing this in the video. Then the Ulcer Index, which is another attempt at measuring sentiment. This is really based around mutual funds because they only have a closing price, the net asset value. But we can see as the VIX has been going down, the Ulcer Index has also been going down. And the Mass Index is not generating a signal right now. The signals that we look for are when we go above the red dashed line and the blue line and then come back down below that. We're far away from those lines, so there's been no need to show this chart. And we're keeping an eye on this because even though the S&P is setting all-time highs numerous times through the past week, we're seeing the weakness developing throughout the rest of the S&P. It's really the mid cap or the mega caps that are really driving the index higher now, similar to what we saw last summer. Well, when we look at an advanced decline ratio based on 19 periods, we're actually dropping a little bit below zero here. That's turning negative based on price. We're still positive based on volume, but we're also coming down. And that's a little bit of a concern to us. And I have other charts that I'm looking at to get more evaluation of, are we seeing weakness starting to come into the S&P? Then we measure how far above or below, in this case above, are we above the 200-day simple moving average? And this is mainly just for information. It kind of looks nice. But when we use this is if we get up to this 14, 15% above the 200-day moving average, a lot of times that will show that we're getting kind of far away here and we're due for a pullback. Well, we're up a little over 11% now above the 200-day moving average. So we're not really focused on this, but if it really goes up and we get a really high reading here, then we will watch this chart a lot more intensely. Okay, and then just measuring, and this is probably not as accurate as the previous chart because I just have to eyeball this. From the October 2023 low up until Friday's close, we're up well over 22.5% here. Or is that 32.5%? It's kind of hard to read. Now, another thing that I have measured on here applied over the summer when we were really going up and setting a new all-time high, and then everything kind of shifted. We had that big down day, August 5th, where the end of the world was supposedly happening. Well, from the top all the way down to here was almost 10%, because that's the definition of a correction. If we go down over 10%, that kind of shifts the whole mood of the market. And after really going up strong and then falling down, we were down just about 10% here. This is when the smart money really started to come in and buy again, and that pushed us up out of that. And we've been doing quite well ever since then. So that's why I have this on here. We're just waiting to see if another one of these measurements actually comes into the picture that's not there right now. Then we have the Connors RSI, which is a momentum oscillator, and I have a lot of momentum oscillators that I look at. This is just one of them, and I only really focus on this chart if we're getting an extreme positive or negative reading, and we're not right now. And these are anchored moving averages. Now, most of the moving averages that I use are simple or exponential moving averages, which uses past data to calculate the current value. Anchored moving averages try to project things forward. And a lot of times when we're in a real solid market like we are now, these can come in and offer a level of support. Well, we keep going up with the S&P, so we're not really near any of these anchored moving averages. Now, a positive thing that you can take away from this is you notice all of these anchored moving averages are going up. And if we do run into some problems, we'll be watching some of these levels to see if they provide some kind of support. Then standard deviation, this doesn't measure direction, it measures speed. And when we're above the moving average, that means we're going really fast, either up or down. Well, we're down below the moving average right now, so I haven't been showing this chart. And then we just keep an eye on the S&P 100, which for quite a while was underperforming the rest of the S&P 500, but now we're seeing it improve, and it really led things higher in the past week. But we're not really seeing any kind of a disconnect between these charts. They're going more in tandem with each other. And then a point and figure chart. No new X's or O's drawn on here, so I haven't been showing this chart, but this is still looking quite positive altogether. Then we have another long-term rainbow going from 50 periods up to 250 periods. All the lines are going up and prices above all the lines. The long-term trend is still positive. Then we have another longer term momentum oscillator called the Special K, just like the cereal. And we've been positive here. Now, one thing that did change a few weeks back is we finally, after waiting for well over a year, we saw the weekly chart turn positive. And that could be good longer term because we don't get an awful lot of signals from this particular indicator. Then on top here is a weekly chart of the S&P, a weekly chart of the German DAX, the biggest stock market in the EU. And then we just do a correlation. This is longer term since it's a weekly chart. And we see that the correlation between US stocks and European stocks is quite high right now. The German stocks had been underperforming, but now they're kicking back into gear and actually turning more positive, as are the whole EU set of stock indexes. Then we look at different areas of support and resistance. This is based on the short term, and it's just a simple moving average based on 20 periods of the open, high, low, and close. We're when you plot this on here, it produces a little mini rainbow, and we're well above the lines, and all the lines are going up. What we're watching for is if we do see a decline in the S&P, will one of these lines end up providing support? Then we're setting a new all-time high here, so I readjusted this. This is if we really start to go down. These are the fib retracement levels as of right now. That's why I say possible, because if we set another new all-time high, this chart will have to be readjusted again, but we're far away from any of these specific levels. Then some broad market measures, the QQQ. Usually when I show this is when we're dropping below the 20 or the 50 period moving average. Well, we're well above that. We were able to get back above it as we were running into some problems earlier in November. Now we're going up and setting all-time highs with the QQQs, and all of the moving averages are going up. So this is positive here. And then we look at the Vixen, which is the volatility measure for the NASDAQ 100, where we mainly focus on the VIX, which is the volatility measure of the S&P 500. And as the NASDAQ 100 has been going up and setting all-time highs, we're seeing that volatility is going down. Then we do some ratios, and this is kind of a strange one. We look at the S&P, and then we look at a ratio between the Qs, the NASDAQ 100, and the diamonds, which is the Dow, and we see there's a pretty strong correlation right now between the S&P and this ratio. And that just shows that the bigger stocks are really leading the market higher right now, specifically the mega caps. Then we look at another ratio, and usually I show this chart every day, but it's been chopping around a lot lately. This is a staples to tech ratio. Staples are defensive, toilet paper, toothpaste, things that you have to have no matter what's going on in the stock market, what's going on in the economy, and they tend to hold up better when the market's under pressure. They did better in 2022. You can see here where staples are outperforming tech. Well, when we finally hit bottom in late 2022 and started to go back up with the S&P, this ratio started to go down, meaning that tech is outperforming. Well, we had a little bumpy ride here, enough to actually generate a golden cross with this ratio. But since then, we've been coming back down and we generated a death cross. And as long as this keeps going down, that just means the tech sector is outperforming staples. And we keep an eye on the bank ETF. We want to watch the financial sector and then different areas within the financial sector just to see if everything's doing okay. And we're coming off of a recent high here. We are pulling back as we've been seeing some profit taking, but nothing too drastic right now. And then we look at the regional banks, the smaller banks, and then do a ratio with the financial sector. And it's showing that the regional banks are holding up okay. They're not really breaking out to the upside, but they're not falling apart either, like they were back when Silicon Valley Bank and Republic Bank and New York Community Bank was really pressuring this ratio. It's holding up for the most part right now. Then I have a couple of rate of change charts. I use these just for informational purposes, or we go back 250 periods. It's long term, and we're still ticking up and looking positive here. Another 250 rate of change chart also has us still above this blue line here, so we're looking positive that way. Then we keep an eye on bonds. We look at a ratio between cash, as measured by the 1 to 3 month T-bill, and then the 3 to 7 year bond. We were getting a little bit concerned because we were going back up. And when this goes up, that means there's uncertainty about interest rates or there's concern about inflation. And this was producing some real worry here, but we weren't really sure why this was happening. Well, the interest rates were starting to go back up after the Fed came in and started to cut rates, which seemed to kind of, they were opposing each other. Now we're seeing this coming back down. However, we went up just enough to start generating a golden cross with this ratio. Now, if this continues to fall, which would be more positive for stocks, that means inflation and interest rates are probably going down, and that's more friendly for stocks. If we continue to drop down here, then it may negate this golden cross that we're seeing and actually turn this back down. So we're kind of seeing a mixed picture where we're going up and almost seeing an uptrend being generated here as this ratio has been coming down. So we watch this just to see if we can get some context as to what's going on in the market. Same thing with this one. We look at TIPS, which are Treasury inflation protected securities. This is what folks get into when inflation's going up and interest rates are going up. And in 2021, that's what we saw. And then we saw this ratio really going down in 2022, and then it started to go back up, and it's still in an uptrend, but we've been chopping more or less sideways here as the market's trying to figure out, okay, is inflation under control? Are we going to see a recession? Are interest rates going to continue to go down, or are they going to start to go back up? This is what this chart tries to uncover. Then we look at the long-term bond ETF, which is in blue, and it's been going up lately. And we look at the S&P 500, which is in red, which has been going up lately. And so we're seeing the longer-term correlation between the two improve, and the short-term correlation based on 10 periods, showing that they're going in the same direction right now. And we do that same thing here with QQQs, which is setting all-time highs, and the long-term bond ETF in red on this chart is going up as well. Not as strong of a correlation, but it is improving as they both have been going in the same basic direction. Then this is kind of an interesting one. We take the 10-year yield in the US and subtract the German 10-year yield, and since US rates are higher, we get a positive result. And then we plot the US dollar index down below. And then we do a correlation, and you can see there's a pretty high correlation between the top chart and the middle chart. And this just shows the interaction between interest rates and currencies. And so we've been pretty solid with the dollar lately. It's been pulling back over the last week or so, but it's been showing some real strength since the election. And we've also been seeing interest rates that had been going up are now starting to come back down. If we continue to fall with this top part of the chart, and we fall with the bottom part of the chart, that's usually more positive for stocks. They like a weaker dollar. But it's just kind of interesting how this correlation is really strong and just shows the interplay between these two different areas of the market. And we keep an eye on the 2-year yield. Now, this really hasn't been all that helpful lately because we've been going back up with the 2-year yield. We're still dealing with inverted yield curves and have for a couple years now. The 10 to the 2 years gone back to being normal, but the 10 to the 3 month is still inverted. And a lot of times what happens when it spikes up and then comes down with the 2-year yield, that will give some short to intermediate term support to the S&P. Well, it's not really doing much right now. It's been going back up and the S&P has been going up as well. So we're not really getting a lot of insight here. Then we look at the 10 to the 2-year yield curve, which, as I said, is just barely hanging on, but it is back to being normal or uninverted. But the 10 to the 3-month yield curve, it's getting close a few times, but now starting to go back down, still showing that it remains inverted here. And we keep an eye on European stocks and compare them with American bonds. And this showed that European stocks were really underperforming the bond prices, but now it's starting to show an improvement and we're starting to come back up into the rainbow. This is mainly more for just informational purposes, but if we really continue to go up, that would be more positive. That means that and the U.S. stocks continue to go up, they would confirm each other with what's happening. Then I have a number of things called possible positive scenarios, and I use a lot of those charts in the daily video. The ones that I don't use, I show here. And this is the percent of stocks in the S&P above their 200-day simple moving average. And I use this chart like an oscillator to look for an extreme positive or negative reading. Not getting that right now, but we are above 50, so that just shows that we're positive, but we're not really getting any additional insight from this chart. And that same basic idea with those stocks above their 50-day moving average. Still coming down, a little bit of a concern there, but not getting an extreme positive or negative reading right now. And then just to give it a little more context, we look at the mid caps as well as the small caps. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.